Rahul Chadha, Founder-in-Chief Investment Officer, Shikhara Investment Management with us this morning. Market veteran Ajay Bagga with us as well. Welcome to both of you. An absolute pleasure to speak with you here on NDTV Profit. You know, just as the world is digesting the magnitude of this victory. Mr. Bagga, let me begin with you. Markets today seem like they might take profits. Is the Trump trade something that can sustain from an Indian market's perspective?
The Trump trade is all about back to the US. And so, Tamanna, if you see from September, the market got it right. A stronger dollar, higher US Treasury yields, higher US stock markets, and declining bonds on the fear of a higher fiscal deficit, more debt in the US, tax cuts, lesser regulation, and de-immigration. So, deglobalization, de-immigration, higher tariffs, bad news for the rest of the world exporting into the US, be it labor, be it goods, or be it services, and good news for the US markets. So the Trump trade is very much about make America great again. It's not about the trade partners. But as far as India is concerned, what does it imply? All these things, as they are rolled out next year, lower taxes, higher tariffs, de-immigration, deglobalization. It will have implications for Indian exporters. It will slow down the global economy because inflation will go up and the rate cutting cycle will slow down. I think all those are the big blocks right now. But we must also caution that politics is one part of it. And right now, because everybody is focused into it, tomorrow we'll be talking about the Fed action, and day after we'll be talking about the NPC in China, the latest Chinese stimulus. So the Trump presidency forms a backdrop, but it will recede into the background very soon. Right now, the markets are quite focused on it, but it will take time to roll out. He gets inaugurated on 21st Jan, and then the policies take root. So we have to prepare for it. The Trump trade, I would agree with you, largely done with. But how much more do the US markets go up from here? Anybody's bet. But he's creating a good environment for the US markets, not so good for the rest of the world.
Rahul, good morning. Ajay, I think that's such a good point, right? Trump trade is for the US, barring IT, which may gain because of our exposure to those corporates there. Everything else may not be so positive for Indian markets, and we've been dancing to our own tune, right? But Rahul, you want to come in on this one. How do you feel about the Trump trade being largely focused on the US? And this is not about India or China as much as this is about looking internal, getting the US back on track.
Absolutely. So I think the reason why Trump got voted back was because the large part of the electorate wanted a change. And being here in the US, I've experienced it firsthand. Inflation was something which was hurting, despite year-on-year number being lower. But if you see from 19 levels, inflation was up nearly 35-40%. So that was one reason. Law and order in certain parts of the US was a reason, and which is why the electorate voted for a change and they wanted a change in policies. And I think till the time we have clarity from the new Trump administration, this is going to weigh on most EMs. So our expectations is, and that's where the sound bites are, that you will have a wave of deregulation kind of a come through. Look, what's happened is over the years, a lot of rules, regulations have been put in, which made doing business a lot harder, more so for small industries, etc. So that's going to be positive for US. One is not sure about the extent of tax cut because look, if the US corporate tax rate goes to 15%, what it means is a large hole in the US deficit. US is already running the highest peacetime deficit at 6.5%. So there are a lot of these things which market would look for. US may grow strongly with what Trump administration is proposing, but look, if the deficits continue to spike and bond yields continue to spike, that may be a derating thing for rest of the markets. I think from a medium term perspective, what is good for India and for the world is that look, your energy prices, particularly the crude prices, may go down because again, the new administration, all about deregulation. So that should be positive from an India perspective. Like the way you said from sectors, I think IT clearly stands out. Pharma may benefit. It is to be seen that when this new administration puts tariff on all imports, what is the extent? Is that 10%? Is that a 20% number? And I think that's really the risk for the exporters from India and from a global growth story.
Rahul, good evening to you. Mr. Bagga, good morning to you. Rahul, the question is for you. Um, the, the belief until the election verdict in the US was out was that let's look at inward domestic facing sectors in India and not quite the global facing sectors. Does that change? IT is up, people are talking about duties and tariffs, and that might help chemicals as well, textiles as well. So does the near-term tactical mood change to global outward-facing sectors from India versus domestic-facing sectors?
Neeraj, I think the reason for that is what is happening in India post-elections. We've seen a distinct slowdown kind of come through. That's also happened because somewhere RBI over last 1 years has been tightening this unsecured lending part of way, which one thought went into the markets also. So I think that slowdown is the reason why investors are looking away from these domestic cyclicals or domestic focused sectors to exporters. And to be fair, one reason was also this soft landing which was happening in the US. You look at the data points, US still growing, whatever said and done, at 4.5 to 5% from a nominal GDP perspective, which is not a bad number for a 30 trillion economy. So with the soft landing backdrop in the US, I think the exporters were a good sector, and I think that is what the market is going to be focused on. One was looking at rate cuts, but you may get one rate cut in November, as what you all were discussing before. But beyond that, with the strength in the economy, you're not going to get too many rate cuts over next 12 to 18 months. So somewhere then that puts a little question in mind that what leads to this revival in the domestic economy. Until the time one finds clear evidence of the revival in the domestic economy, I think the focus is going to be on the export-oriented sectors. One more point to add here would be, though we all are talking of broad-based tariffs, but it's highly likely that China would get much higher tariffs compared to rest of the other countries, and that leaves an opportunity for some of these Indian chemical exports, Indian pharmaceutical exports, or the EMS names from India. So it's negative, but less negative than the biggest exporter, and then that kind of an exacerbates this China plus one, which is happening across sectors.
Ajay, do you agree? I mean, now that China is in the doghouse, and it's probably been one of the big reasons why India has seen the kind of selling that we have in October. I mean, of course, Trump's dislike for China is far more than his indifference or love for India in some ways, right? Keeping that in mind, do you feel like at a macro level that makes us or puts us in a better position, and this could mean some form of foreign inflows returning, because you still have to play the emerging market pack, right? While the chunk of your investments will have a home bias, the money coming out of the US would have to come to India. Would you agree?
The big question is there money coming out of the US? If you see,
Ajay, just a quick one on that. While all your institutions globally, so insurance companies, universities, trust funds, pension funds for that matter, do maintain an emerging market allocation. Up until a few months ago, India was overriding that with a chunk of those flows coming to us. But with China now not so positive, what I want to understand is from that couple of percentage on a portfolio, would that money come back to us?
some of it, yes, but we have our own issue with the fundamentals, with the earnings disappointing, with the down rating of the Nifty EPS for the next 2 years on the anvil. So unless we get some counter-cyclical measures, we have four issues. The government spending didn't catch up right from March last year when the elections were announced through July. We had very slow government spending. The infrastructure spending also slowed down. September has seen a catch up. Let's see what the October numbers bring in. But we need a counter-cyclical boost into the economy. Consumption, urban consumption is growing at 4% plus, rural consumption at 5% plus. that's barely meeting the inflation. So we are not growing on the consumption front. Infrastructure, there's been a mild slowdown. So as a foreign investor, I would say it would still be wait and watch for now. I've done 2, 3 sessions post yesterday with foreign investors, and the concern has been that only that China is going to bring in a depreciation of its currency as it did in Trump 1.0, and that will mean most emerging markets will also see their currencies going down. The Mexican peso yesterday went down all the way 3% down in anticipation of this. So, too many moving parts right now. And the second big part is that we could absorb that 1 lakh crore of selling in October. But our normal run rate in the DIIs is about $5 billion a month. So absorbing that kind of a sell-off for 2, 3 months will become an issue. And that could mean faster cuts in the market. What Tamanna mentioned in the morning editorial take, yesterday also you had FIs selling about 4,400 crores. Did that happen pre-Trump or post-Trump? That we don't know. The timing only the custodians or the actual sellers will know. That was it selling in the morning. So today we'll get an idea of what things are happening. But as I mentioned, now Fed comes in, China comes in, and Monday we'll have another thing. Now, was Iran holding back for the elections? And does Iran unleash something after Friday prayers? We don't know. So other imponderables come in. I would say our markets are in a spot of a bother for the short term, and I don't see FI returning very soon, maybe by February or so, with new allocations we might get in. But right now, India is not looking that attractive a market given the elevated valuations, given what's happening globally, and given the earnings falling in that kind of a scenario, with RBI raising its hands yesterday, saying that the governor doesn't see a rate cut anytime soon, and RBI making sure that unsecured lending it's clamping down on. I think we don't have a fundamental thesis right now for the very short term. That would be my point.
Absolutely. I wish we could do a more detailed chat, but we have to wrap up. Great to speak with you, Rahul. Great to speak with you, Ajay.